March 11th, 2026. Mark that date. Silver sits at $84 per ounce with the world's largest physical demand engine completely offline. China has been dark for an entire week. Their markets closed. Their banks silent. Their buying power absent. And in that absence, silver climbed 9%. Gold reclaimed 5,100. Both moved without Chinese participation. Now ask yourself the only question that matters. What happens when Shanghai reopens Tuesday morning? Because the answer to that question is not speculation. It is mathematical certainty, and the market has not priced it in yet. This is not the first time a reserve system has faced this exact moment. This is not new. This is a pattern that has repeated 3 times in recorded history. Every single time, the sequence is identical. Every single time, the outcome destroys the empire that ignored it. Rome debased their currency to fund endless wars. The denarius went from pure silver to worthless bronze in 2 centuries. When the soldiers realized their pay could not buy food, the legions stopped fighting. The empire collapsed from the inside. Verified. The Dutch Empire controlled global trade in the 1600s. Then came war with England. Debt exploded. They printed money to cover it. The guilder lost 70% of its value in 30 years. Amsterdam went from the financial capital of the world to a footnote. Their reserve status evaporated. Check. Britain held global reserve currency for over a century. 2 world wars drained their gold. They kept printing pounds to maintain the illusion of strength. 1949, they devalued 30% overnight. By 1976, they needed an IMF bailout. The pound sterling went from backing the world to begging for loans. Verified. Same pattern. Same sequence. Same outcome. Currency debasement to fund wars and welfare. Denial while the structure cracks. Then collapse when the physical settlement day arrives and the vaults are empty. That is not theory. That is the historical record. And if you think the United States is different, if you think the dollar is immune, then you have not been paying attention to what is happening right now in the commodity markets. Because what is unfolding in silver is not a price move. It is a settlement crisis. And settlement crises do not resolve with happy endings. Let me show you what actually happened last week while everyone was watching headlines instead of data. COMEX registered silver, the metal that is genuinely warrant-issued and available for physical delivery against futures contracts, sat completely unchanged at 88.19 million ounces going into the weekend. No inflow. Zero. The February contract is finished. And what stands out is not just the absence of outflow. It is the complete absence of new metal coming in to replace what has been draining for months. Eligible silver, the broader category sitting in vaults but not immediately available for delivery, continued shrinking. Another 1.2 million ounces disappeared in a single session. Total COMEX inventories are still seeing net outflow even as the registered figure holds flat. Here is why that matters structurally. The March contract open interest still sits at roughly 222 million ounces. Registered silver is at 88 million. That implies a deficit of well over 130 million ounces between what is deliverable and what is theoretically owed. And the roll from March to May is still far too slow. Only 15 million ounces rolled in a single day. With 4 trading days remaining before March enters settlement, the math does not add up. If you are hearing this and thinking that sounds like a structural problem, it is. Pull the COMEX inventory reports yourself. They are publicly available and updated daily. The ones who actually check these numbers understand why the roll pace matters. This is not opinion. This is pattern recognition. Now here is where it gets dangerous and where the mainstream is completely missing the connection. China was offline for the Lunar New Year holiday all week. One of the largest physical demand engines on the planet, essentially dark. The conventional logic said metals would struggle without Chinese participation. Instead, silver was up nearly 9% by Friday's close, printing 84.57 on the futures. Gold reclaimed 5,100. Both of those moves happened with China absent from the market. Let that sit for a moment. The next question is the only one that matters right now. What happens Tuesday when Shanghai reopens? Here is a data point that answers that question better than any forecast. The largest silver recycling company in Shenzhen, one of China's primary precious metals trading hubs, was offering the equivalent of $93 per ounce to buy back 9999 pure silver going into the weekend. That is the physical bid inside China with their own exchanges still closed. Western futures are at 84. Shanghai spot was already running at 86. When the Shanghai Gold Exchange reopens Tuesday, the premium differential and the physical bid underneath the market are going to make themselves known immediately. The ones who track these spreads know what a $93 physical bid from a major recycler means when the exchange price catches up. This connects directly to something that has been building for years that nobody wanted to acknowledge: the physical paper disconnect. The Silver Institute and structural supply data have confirmed we are in the sixth consecutive year of silver running a structural deficit. Annual global mine production is approximately 800 million ounces. Projections for 2026 show a deficit approaching 300 million ounces. That is more than a third of everything the world extracts from the ground in a full year. That is not a rounding error. That is a compound structural failure that paper markets have been papering over with forwards, leases, and rehypothecation for years. And the facade is cracking. Not might crack. Is cracking. Right now? Then there is the story beneath the story. The one about what actually happened between JP Morgan, China, and the silver market over the past several months. China had spent years buying the dip in silver, conditioned by years of suppressed prices to treat every pullback as an opportunity. That behavior created an addiction to cheap silver that left Chinese industrials structurally short when the market shifted. When JP Morgan pulled 13 million ounces off COMEX registered inventory and reclassified it to eligible, meaning it disappeared from the deliverable pool, a Chinese industrial that had tried to hedge its short position on COMEX and take delivery was told in plain terms that the silver was not available. What followed was a short squeeze, with China going limit up as the short covering orders hit a market that could not absorb them. JP Morgan, according to documented refining and market sources, spent the following weeks filling that order, pulling silver concentrate from Latin America, while Chinese buyers attempting to source the same material were told it was already contracted. One Latin American producer confirmed being offered $80 an ounce by Chinese buyers, $10 above prevailing prices, because JP Morgan had already locked up the supply. This is not a metal story. This is a proxy war. JP Morgan acting as a proxy for Fed interests. The PBOC operating through its own market representatives. Silver is the battlefield where that conflict is most visibly expressing itself right now. And the Chinese market structure made things worse. A listed open-end fund in China was trading at 30% above its net asset value as retail and speculative buyers piled in. When the industrialists who needed lower prices to cover their shorts pressured regulators, the fund was switched to liquidation-only mode while silver was still elevated. Sound familiar? It should. The Hunt brothers know exactly what liquidation only looks like. The difference this time is that the forced unwind did not kill the market. Silver held. The physical demand underneath the paper structure was too large to be crushed by a single regulatory intervention in one country's market. And that tells you something critical about what comes next. Because when a market survives a liquidation event that was designed to crush it, that market is no longer operating under the old rules. It has crossed a threshold. And the threshold it crossed is the one between paper price discovery and physical settlement reality. The LBMA, the hub of the global silver lending market, effectively ran out of above-ground available stock. Lease rates exploded when the inter-dealer lending network inside the hub seized and banks had to go public to borrow silver. That is not a forecast. That is a documented market event. When the inter-dealer market stops leasing to itself and has to advertise publicly, it means the informal cushion is gone. The system that was built to absorb shocks can no longer absorb them. You cannot unsee that once you understand what it means. Now connect it back to Tuesday. Shanghai reopens. Physical bids inside China are already running $9 above Western futures. The COMEX March roll is dangerously slow with 4 trading days left. Registered silver is unchanged. No new metal entering the deliverable pool. Gold is above 5,100 with China offline. And the yuan just strengthened to levels not seen since May of 2023, which tells you something about capital flows and the pressure on dollar-denominated reserve systems. When silver dropped into the 72 range a few weeks ago, almost every voice in the metals space flipped. Suddenly, everyone was bearish. Capitulation language everywhere. But there was a structural support zone between 70 and 72.60. There was a bullish swing failure pattern. There was a potential inverse head and shoulders forming. Nobody was talking about that setup when the sentiment was dark. Nobody. Now silver is at 84.60. That is not coincidence. That is what happens when you read the structure instead of reading the headlines. And there is a reason sentiment behaves exactly the way it does at those moments. The 1974 U.S. Embassy cable, a declassified government document, not a theory, not speculation, an official document, openly described how a large gold futures market would make physical trading seem minuscule, amplify volatility, diminish demand for physical metal, and discourage citizens from long-term holding. They understood the psychology 50 years ago. Flood the market with paper. Amplify the dips. Let sentiment do the suppression work for you. You do not need to force people to sell. You just need to scare them enough that they do it themselves. When silver hit 72, sentiment did exactly what it was designed to do. Almost everyone sold the narrative instead of reading the tape. The structure never lied. The headlines did. And that brings us to the part nobody wants to talk about, because it is too uncomfortable to process. We are not at the cliff. We have already walked off it. The free fall has already begun. Most people just have not looked down yet. Here is what the collapse looks like for a normal person. You wake up Tuesday morning. You check your bank app. The balance looks fine. You go to the ATM. It says temporary service interruption. You try another bank. Same message. You go inside the branch. There is a line out the door. People are angry, confused. The teller tells you there is a daily withdrawal limit now. $500. You ask why? She does not know. She just got the memo an hour ago. You go to the grocery store. Milk is $11. Eggs are $18. Ground beef is $32 a pound. You think it is a mistake. It is not. The manager tells you prices updated overnight. Supply chain issues. Currency adjustments. You do not understand the words, but you understand you cannot afford food anymore. You go home. You turn on the news. They are calling it a temporary liquidity event, a coordinated reset, a necessary adjustment for financial stability. They are not calling it what it is, a collapse, because the moment they call it that, the panic becomes irreversible, and the smart money already left. Months ago, they did not wait for the news to tell them. They read the data. They saw the pattern, and they moved into the only assets that survive this every single time it happens. Hard assets, physical metal, land, things that cannot be printed, cannot be debased, cannot be liquidated by a government decree. Gold has revalued higher in every single currency collapse in recorded history. Not some, all. Silver follows because it is both a monetary metal and an industrial necessity. When the confidence in paper evaporates, the world does not stop needing metal. It needs it more. And the price reflects that reality, whether the futures market acknowledges it or not. Because futures are a derivative of confidence. Physical is a derivative of reality. And reality always wins. Not might win. Will win. Always has. Always will. The only variable is how long the gap between the two lasts before it closes violently. So here is the bottom line heading into Tuesday. Shanghai reopens with a physical bid inside China running $9 above Western futures. COMEX registered silver has not seen a single ounce of new metal enter the deliverable pool, and the March roll is dangerously behind with days left to settlement. Gold held above 5,100 with China absent from the market. Think carefully about what that says about the demand structure. And the silver market itself, which was structurally built to function under $30 per ounce according to everyone in the supply chain who watched it seize up during the initial move, is now operating at nearly 3 times that level with physical demand that is not going away. The unresolved question, and this is the one to watch, is whether the COMEX March settlement produces a genuine delivery demand that cannot be absorbed by the current registered inventory. The math between 222 million ounces of open interest and 88 million ounces of registered silver does not close quietly. Watch the roll pace Monday. Watch the registered figure Tuesday morning. And if you have not pulled those vault reports yourself, now is the time to start. Verify everything. Pull the COMEX inventory reports. Look at the Shanghai exchange data when it reopens Tuesday. Check the LBMA lease rate history. The primary sources are there. They have always been there. The ones who look find exactly what the data shows, and they stop needing anyone to tell them what to think. Because this is not about belief. This is not about optimism or pessimism. This is about pattern recognition. And the pattern is screaming. Same pattern, same sequence, same outcome. Rome debased and collapsed. The Dutch printed and collapsed. Britain printed and collapsed. The United States is in the final chapter of that exact same story. The only question is whether you see it before the majority does. Because by the time the majority sees it, the opportunity to position is gone. The smart money does not wait for confirmation. It does not wait for the news to validate the thesis. It reads the structure. It sees the math. And it moves. Not might happen. Will happen. The settlement day is coming. The vaults are not full enough to meet it. And when that reality expresses itself in price, it will not be gradual. It will be violent. Subscribe if you want to see what comes next. Because Tuesday is just the beginning.